Hello, good afternoon. Thank you for joining us. So on this panel, we're going to discuss with our very known panelists on strategies across the various shipping sectors and cycles, and discuss how investors in the shipping market develop strategies across the various asset types, across the various points in the cycles for its asset type and the various structures, and also elaborate on how the capital markets can help fund those transactions, implement them, and how they assist market participants to make new investments. So I would like to ask our panelists, each of our panelists, to briefly provide a short background on themselves and also on the companies that they represent, so that afterwards we can kick off with our discussion.
Good afternoon, everyone. It's a pleasure for me to be here. Thank you, Nicholas, for inviting me from Hamburg. My name is Bastian Hagebeuker. I'm the co-founder of a company called Blue Star Group. We have the same name, but we are not attached to Blue Star Ferries. It's a coincidence. We are a shipping investment firm. We have a history investing in container vessels and dry bulk vessels. And as our latest adventure, we have started 2.5 years ago by setting up a new company which is called Windward Offshore. And it's a company that operates fully integrated offshore wind service vessels. And I'm delighted to be here.
Good afternoon. My name is Sofia Kalomenides. I would like also to thank Nicholas and Nölke. It's a pleasure and an honor to be part of this panel. I am the Europe Central Capital Markets leader for Ernst & Young. That covers around 33 countries, starting from the Nordics, and goes across into Turkey and Central Asia. Diverse markets and very interesting and exciting transactions. I'm also an audit partner. I'm a US CPA, and for the past 20 years, I've been auditing a number of the Greek shipping companies. Thank you.
Thank you very much. My name is Felix Nölke. I'm managing director at Hamburg-based asset manager MPC Capital, so similar to Bastian here. We are the largest shareholder of the Oslo-listed container shipping company MPC Container Ships. In my role as head of Maritime investments, I'm responsible for all, let's say, shipping-related investments. And similar also to Bastian, we actually ventured into the offshore wind sector during the course of last year, where we launched an entity called MPC Overseas Offshore, backed by infrastructure funds out of Central Europe. And most recently, we also launched an investment platform together with very knowledgeable investment partners in the maritime space called MPC Storm Opportunities. So thank you very much for having me.
Good afternoon, everyone. My name is Alexis Atteslis. I represent OHA. We are a 110 billion multi-strategy asset manager across the capital structure. We've been investing in shipping for the last 15 years, again, across sectors and across different capital structures.
So let's start our discussion with thinking how investors like yourselves, and more generally, evaluate the risk and return across the shipping sector during the various cycles, the various asset types, dry bulk, tankers, containers. How do you form investment decisions? And currently, where do you see the best potential returns at an acceptable risk in terms of asset class? And what you think doesn't really work and you see capital and investments pulling off?
Of course, it's a pleasure. I think it's a very difficult question to answer, especially because shipping and many other industries as well are facing obviously the current global dynamics that affect all of us, and we have talked about that or heard about that today quite often. Why is this difficult? Because if you want to invest in shipping, you typically, from my perspective, start by looking at where is it interesting to buy into a market from a valuation perspective. And then the second element is obviously supply and demand with regards to assets in that market. That is something that is difficult in current markets. I'll give you one example. In the container market, supply and demand in the midterm looks quite fascinating, but still at the same time, there was tremendous amounts flying into investing in new vessels in the container market, driven by the developments and the outcome of COVID over the last couple of years. So my personal view is, and I can only speak for the markets that I have experience with, which is offshore containers and dry bulk. My personal view is the reason for investing and developing our own offshore wind company is driven by mid and long-term fundamentals. Why? Because we believe in the market of offshore energy, not only offshore wind, but driven obviously also by the technology of offshore wind. And this provides a long-term basis for growth and the fundamental for investing into that market. The other two markets that I have mentioned, they are obviously in a much more mature stage. So you look at other factors. Our driver historically for investing into container ships was finding long-term employment and then structuring the capital side the way that we make a nice return on those deals. That has become more difficult for the last couple of months and actually almost years, for the simple reason that the amount of capital available for financing container ships, although we have an amazing order book, is available, and therefore the returns have basically shrink down to a level where it's at the moment not so easy to structure these type of deals. On the dry bulk side, the momentum is a little bit different. I think we have great opportunities in the dry bulk market, especially in specific sizes where there's very limited order book, the yard capacity is limited, so the very simple drivers of supply going forward and the midterm outlook of supply, for me, supports investments on the dry bulk side. And fundamentally, and this is obviously always important to look at fundamentals when you think about investments, I would like to summarize my answer to this question in a way that we are very lucky that we all work in an industry which is not that impacted by what is driving global capital markets these days, which is deep tech and AI. So changing work environments, etc., because of AI is not really an issue for shipping in the near-term future. It can enhance things, but it's not risking our industry, which is why I think there is a big differentiating factor to many other industries.
I think if I try to summarize what Bastian said, it's difficult. I think it's exceptionally difficult these days, maybe more so for institutional investors who would take a more fundamental view, and fundamentals are more difficult when you're at the top of the cycle. I think the traditional analysis that we've all been doing, or new people to the industry have been doing, long-term averages, medians, reversion to the mean, obviously not really relevant these days when you are in most sectors top of the cycle. And actually, I think the technical in terms of the market dynamics is also quite interesting, and it's making it more difficult, which is there's so much capital availability. There's no bargains. There's no motivated sellers. And so I think the cash availability, the fact that you don't have any debt issue in the market makes it more difficult. I think the last few years has been all about black swans. The market has benefited at everything thrown at it, and it has all been about optionality. And I think the way we process it today is you cannot look at demand supply. Of course you do, and you have to do it, but it's all about trying to create optionality in the least expensive way, with some downside protection, which can be from employment or certain sectors. But it's definitely not the easiest market. I think there's a distinction between looking at this industry as a traditional ship owner with a more long-term perspective, without looking at IRR sometimes, than a more, I guess, institutional investor.
Yeah, no, I think I would like to underscore that. I think the topic of optionality is obviously key, and in our house we tend to have a bit more of an, let's say, industrial asset management approach. Hence, we work ourselves a little bit backwards in terms of protecting the downside when entering into investment, and then seeing how we can increase optionality towards the back end of an investment during certain measures that can be taken throughout the project, basically, right? And I think we have seen that also, you mentioned shortly with regard to technological advances. You can see rather investments in assets during the lifetime of an investment project. So I agree with Bastian that it has become more difficult simply putting on long-term charters and waiting for a great return. I think that there's more groundwork to be done during the lifetime of a project or an investment. But if you have a good downside protection, there is optionality in many projects, in particular if you have a more industrial approach with regard to that.
So a different aspect of investing, not only investing directly on shipping assets, is also investing in corporate platforms that own these assets. We have seen recently a rise in JV agreements, in partnerships between ship owners or ship owners and traders. We have seen investments in listed companies with other companies building up various stakes. We have seen spin-offs or attempts or people thinking of doing an IPO. How do you think that this type of investment in corporate structures, differentiate from going on an investment to a specific asset? And are there any specific advantages, disadvantages for corporate entities that are private? Are there advantages to try to go public? Maybe Sofia, you can start.
Thank you, Dino. I guess there's always a dilemma between remaining private and going public. And it's common. I mean, I'm going to talk around some of the benefits, but it's common across sectors. And I've seen many companies, managing the benefits and really growing and really developing in their equity stories because they went public, versus some companies that really did not understand what it means to be public and really struggling and having certain challenges. So I just want to share a couple of these benefits. I guess one of the biggest benefits of being a public company is better access to capital. Investors have liquidity, and being a public company, you have the ability to access that capital a lot more quicker. The other is the image. And again, if you're a larger company and you want to maintain the best talent, best executives, being a public company allows you to locate them, hire them, keep them, and reward them, because you have the ability to use stock options, long-term incentives to really reward the valuable employees. Another thing is you get notice. Right? And what does it mean you get noticed? Is that companies that are listed are valued higher. And I've heard in various panels the concept of transparency. As a public company, you're a lot more transparent, you're reporting a lot more information, investors have a lot more information about the company, so you're able to value higher. And there's more predictability on your performance because all that information is out to the public. Now, there are challenges. And I'll start off with the most simple list. I know there are more challenges that are more difficult than I want to say, but it's to the boards and to the management. Not only do they have to, manage their business and the challenges we heard in each and every panel about where, your sector is and, what is happening with the regulators, the regulatory frameworks and the volatility of the markets. But beyond that, it's now the boards and the executives will need to manage investors. And that is an important part of the job of a public company and its executive. The other is, of course, the cost of doing an IPO. It's significant. But sometimes, depending on which markets you're actually listing, you continue to have significant costs because of the regulatory requirements to do that. And last but most important is you lose control. And for owners and founders that have built their business and they have developed it and have grown it, bringing in new shareholders means there's a vote and there will be dilution. So understanding that you will not have that particular control means also that you are going to be reflecting a lot more financial information more often. And you'll, as I mentioned before, you'll have to be presenting and discussing with your investors. But on top of that, the management is held accountable for the promises they're making, for the projections they're actually describing to the investors. They're going to be held accountable at one point in time. That's going to impact the company and its price. So overall, is there a simple question around the dilemma to go public or to remain private? Well, it all depends on the priorities a particular company sets and their appetite for risk. So if you value better access to liquidity, to capital, if you want to have ability to reward your employees with the various options and instruments I mentioned before, then maybe becoming a public company is the right way to go. But ultimately, if you don't have the appetite to deal with these types of risks relating to losing control or having to be more public and have to share a lot more information about your business, then maybe finding alternative means of capital is more appropriate.
Thank you, Sofia. Also, following up on the same question, maybe Alexis, can you give us some input? What you look at when you evaluating an investment in corporate structures, in a corporate platform, or even a listed entity, if you have ever looked at something like that?
Yeah, so historically we haven't invested in listed equities. I have a slightly different view than Sofia on whether shipping companies are well suited. It's an overgeneralization for the public markets in terms of cyclicality, in terms of the investors understanding the cyclicality, in terms of the scale and liquidity in that shareholding, in that stock to make sense. I would say, of course, we have today a few very large companies. The universe is not very big. For the size of the investments that we usually make, we found that investing in public companies means that you have less liquidity than actually owning the asset. The assets are more liquid. The S&P market is more liquid than the capital markets. And also, we don't have the corporate governance and the control that we would have if we had invested direct. I think what's important for us, we're not a ship owner. We understand shipping, but we're definitely not a ship owner, is actually finding that partner. We've done a number of joint ventures over the years across different subsectors, finding that partner, sharing the same philosophy and way of doing things, and of course, a similar view on the market. Of course, that's dynamic and it changes over time, and that's why that relationship and that alignment of interest is key, is as important sometimes, or even more important than actually the actual investments you do.
Thank you. Felix?
Well, I mean, I'm part of a universe where we have a couple of listed companies, to be perfectly honest. But I guess also looking at it is how the way we view it. We as a sponsor, we are an asset manager, hence the entities that we control that are also listed, they're a means to an end, so to say, so to provide investors and institutional investors with a platform to invest in a certain sector and ultimately get exposure towards these shipping assets. Other than that, I would echo basically also what Alexis said with regard to that, where it comes with advantages and disadvantages ultimately. And the access to capital in particular, also with the rise of the bond market in the Norwegian market today, has shown that also private companies have the means to access a different variety of capital. So there's no reliance or necessity necessarily to go public, and also are in a position to present quality information. So I think in today's world, it becomes a much more blurred, and similar to what Alexis said, I think it's more difficult from a liquidity perspective on the stock to have that as an advantage or disadvantage, given the alternatives that you also have in today's market, basically.
Okay, thank you. And Bastian, maybe you can provide us with some input on how partnerships would work in corporate platforms, how you, if it is better or not to make an investment through a partnership and the JV structure, or go on your own. I think you have experience in both ways.
Absolutely. So the company that I mentioned earlier, Windward Offshore, was set up in the beginning from basically the very first day as a joint venture. And one of our co-founding partners and investors was Diana Shipping. It was set up in a way that it's governed and structured as a listed company with a diversified set of shareholders, as it would be a listed company, but it's operated and set up as a private company. And the reason for that is that I think the other factor that we have not touched base on is timing for a public listing. I think timing for our company at the point in time when we established it, obviously, we wanted to create a market position in the market of the growing market of offshore wind, and establishing this market position as a private company. As being a listed company, I think we all know there is another element that is driving your day-to-day work, which is a completely external factor, and that is market momentum, or momentum in general. So your valuation and the external perception of your company is driven by external factors that are not predominantly driven by market fundamentals of the market that you're operating in. So sometimes the potential liquidity that you get in capital markets is limited because the momentum is not there. And it can be completely the opposite of that. You have huge liquidity because the momentum for a specific asset class is there. So as soon as you look at public equity markets, you have many factors to reflect on. And I believe there is a huge chance in capital markets. And I also believe there's a great benefit for many companies in line with the elements that Sofia has mentioned. But it depends on the timing in terms of where the company is in its own development, and the timing on when and for what reason you want to enter the capital markets. And until then, I think, reflecting on what Alexis has said, there is, at least to my opinion, there's also the chance to raise capital in the private markets to support growth and to develop the company into a certain stage that also justifies a public listing. Because what we have also not mentioned is size requirement for a listed public company for the various reasons. So I think it all needs to be put into the perspective of the stage the company is in and the current goal that you have.
Dina, maybe I can just continue. I agree with what Sebastian is saying. I guess it's important. Going public is not for every company. You know, in the past, we've seen companies with no assets. In 2020, 2021, the capital markets transactions, especially in the US, multiple of the multiple growth in comparison with previous years because of SPACs, right? Special purpose acquisition companies, which is what? It's a vehicle to invest in the next 2 years, the money that you're actually obtaining from the markets. There's a lot out there. How many of those have been successful? Not many. So I feel what Sebastian is saying is important. And we're in an environment where the markets, 2025 has shown a pattern of growth. There is a quiet optimism about the markets in 26 and 27, but it's for those companies that have strong fundamentals, that are going to be able to take their growth story, their equity story to the investors and be able to support that there is an opportunity for the investors to invest in them. And some of the things around this particular sector is around, a modern fleet, the size of the fleet, whether it's single or not. So, I mean, depending on the profile of the company and what the investor appetite is today, that window is very small. So if you want to be able to attract those investors during that small window, you need to be able to have that profile and be able to pitch your equity story.
Thank you, Sofia. Mentioning many SPACs that haven't worked, I think gives me a good lead to my next question, which is what makes shipping investments attractive to institutional investors, be it in listed markets or in private markets? What differentiates it from other sectors where there are opportunities to invest? I think both Felix and Alexis, they have made, their companies have made investments also in sectors other than shipping. But what makes shipping attractive specifically?
Yeah, actually, shipping is a relatively small part, but big. We've done more than 2 billion in shipping in equity over the years. But I think why got attracted to shipping, other than being Greek and somehow you need to find your way to shipping even if you're not a ship owner. I think it's first of all, it's hard asset. It gives you downside protection. There's an income yield. It's cyclical. Going back to the optionality that provides opportunities to make excess returns. I think if you look at the returns over the cycle, they're not that interesting, but no one actually makes those returns. Some people lose, some people make, depending on when you exit and when you enter and when you enter and exit. I think it's less competitive, actually, if you look at it for people in my industry, alternative capital providers. It takes some kind of expertise. A lot of people have lost money over the last couple of decades. There's definitely institutional capital and private equity that invests in shipping, but it's definitely a lot less competitive than in other sectors. I would also say that there is the opportunity to deploy sizable investments in capital, given the capital intensity of the industry.
Yeah, I think also that what we're starting to see now quite a bit also on the private side is that institutional investors, infrastructure funds are starting to get exposure via the shipping industry to meet a trend, so also other indirect, say, sectors and really just going on the derivative investment there. So we've recently seen a big transaction also of the German market from MEAG investing into, let's say, offshore wind related and transport type investments. So I think that is a way in our alternative, as Alexis also mentioned, there is a lot of competitiveness with regards to other larger sectors that are being invested into, and shipping just also provides you with an alternative edge ultimately to get exposure to a certain trend or to a certain growth trajectory. So, and I think this is also something that the industry should embrace.
Bastian, any view on, I mean, you have only been investing in shipping, but what makes it so attractive for you?
I think what makes it so attractive are two things. So I'm not originally from Hamburg. Mm-hmm. So I'm not originally from a geography in Germany where shipping plays a big role because it's rather central. So my intention was an emotional attention after university to go into shipping. Okay. And I think this is an element which we shouldn't forget. Every single investment, obviously there is an analytical driver which drives the decision, but in the end every single investment has also an emotional component. You would never invest in something, at least that's my philosophy, that you don't like. So I think what is great in shipping that I don't know anybody that works in shipping that doesn't like it. So this is also the element for most investors coming into this segment. The other element that I also think was it's very crucial, and we have seen it over the last few years since 2020. It's the backbone of many other industries, and it's a backbone of development in societies globally. And when you consider this as a factor, you will see that it's therefore it's a globally crucial industry to be part of, and that is also an important element for people investing and driving capital into certain industries.
Let's move on to some final questions as we're also running out of time. So one question is, if you had to give one piece of advice to a CEO, to the management of a company that is contemplating a public transaction, being an IPO, a public offering of equity, a bond offering. What would you recommend? Sofia, you can start, but
I'm
we can have the
I'm
user
very
review.
excited about this question. Do not underestimate the process and the time required.
Okay.
It is a very intense process to list a public company, and not only for the CEO, but for the entire company. And underestimating what this means and how much of their personal time will need to be involved in various work streams, while on a daily basis you're running a big business, is really, I think, the part that when I talk to companies after they've listed, they're like, okay, I knew I had to do all this, but not necessarily how much of my personal time. And I guess what I would recommend is if companies are thinking of doing a public offering, to really look at their people, both internal and external, and start and seeing that if they have the right number of individuals with the right level of skills, to really help them de-stress the process once the transaction's underway.
Well, I think it's difficult to say, obviously, or to make a generalization, but I think in general, if you're looking at most recent transactions which have been successful in the capital market space, again, looking a bit to Norway and the US, tremendous management teams, clarity with regard to the strategy, execution, both from a capital markets perspective as well as from a general management and organizational perspective, right? So I think companies that are good at what they are doing, they will also be good companies to be listed, both either via bonds or also on the equity side. If that's the generalization we can give, then I think that should be it.
All right. And let's move on to the final question. Very quickly, each of you, if you could give a recommendation on what would be the ideal investment in shipping currently. If you had 100 million to invest, what would be the sector or asset that you would focus on the most?
I'll take the difficult question first.
Maybe 100 million is a little bit low for you, Alexis. Maybe 100 million is a little bit low for you.
No, it's not. It could be 100, it could be 10, it could be 1 billion, it doesn't matter. There's plenty of capital around this room, more than any other investment fund, I think. So I would say it's definitely not one investment. There's nothing that screams cheap or super obvious. It's probably more diversified. I think sectors which are a bit more industrial. We just made an investment in chemicals, for example. The fundamentals look a bit more attractive. The characteristics of the industry I think, are more suited for institutional capital. I think it's hard to say. I mean, for us to sit here and tell you to do dry bag or containers is not. The audience knows a lot more about the sectors than us. But I think definitely diversified. Definitely not one point in time. Definitely not one type of investment. Not all speculative asset play. Maybe some more income generating. Maybe some more non-traditional shipping. More industrial.
Felix?
Yeah, I think I can just echo basically the same, right? So having just raised a platform that's targeted to invest into a diversified portfolio of investments, look for the right partners, it's in our opinion much more important than picking the right sector, so to say, so that you also can sustain downside scenarios. So yeah, build a diversified portfolio with good partners that really know what they are doing, rely on that, and that would be my recommendation.
I think I do not have much to add, but I would say it's the industrial element that I would like to emphasize at the current market levels where valuations are. I think how crucial the company is in its own supply chain and its position, and how it can be industrialized and grown. That's an important element, because I think growth can come from building more ships, but growth can also come from adding value creation by adding services, so becoming more industrialized. And that's an equity story on its own, which is sometimes difficult to tell in shipping, but it can be a quite important one at markets that are high.
Great. I think that this wraps it up, and thank you all so much for your input.